Hello, girls. Let's start with our topic financial derivatives, forwards, futures, and options. What are financial derivatives? What is a derivative? Derivative is any instrument, any financial instrument which drives its value from an underlying asset. So it does not have any value of its own. A derivative instrument does not have any value of its own, or it does not even have any physical existence, but it's driving its value from the underlying asset on which you have taken the derivative contract. So returns from a derivative contract are linked to returns from the underlying assets that you've taken the derivative contract on. Now, what could be those underlying assets? Those could be simple stocks. When I say stock, there are stock futures that are traded, and stock futures are definitely derivative contracts of individual companies, individual stocks in the equity market. Then the underlying asset could be equity indices itself. You could uh, trade, or you could have a derivative contract on the index value. So the underlying asset or the variable could be equity indices, they could be bonds, they could be commodities, they could be interest rate indices, it could be anything that you could think of. You would know that nowadays there is a lot of derivatives or trading going on in terms of your carbon credits also. So anything that you could think of, you can make it as any asset that you can think of, you can have a derivative contract on that. If we have a look at the commodities, you would know that the whole setup, or the derivatives trading started with commodities itself. And why did it started with commodities? And especially when I say commodities, I mean more of agricultural sort, not of metals like gold and platinum. It rather started with the commodities that are in agricultural processes. So why did it start from there? Probably to hedge the price risk that is associated. And then it went on, and it grew, and financial derivatives were introduced. Now, the first leap towards organized derivatives market came in 1848, when the Chicago Board of Trade, CBOT, you would know, is the largest derivative exchange in the world. It was established somewhere in the 1800s, 1848 to be precise. And again, like I said earlier, the first thing that was traded was a forward contract where the underlying asset was wheat. So wheat was the commodity. Grain trading. And again, why did they go for grain trading? To reduce the risk of price between the producers and consumers of wheat. And if you talk about India, you could do derivative trading through your exchanges, such as your NSE or BSE, especially if you want derivative trading uh, for stocks. But if you would want to trade in commodities, then we have exchanges like MCX and NCDEX. MCX is your multi commodity exchange. NCDEX is your National Commodity Derivative Exchange. So we have those exchanges where you can get into derivative trading. And generally in India, we trade in futures and options, or as we say, F and O for short. So moving forward, I think we have discussed this point already of grain trading on CBOT. How did derivative trading begin in India? So here we have the point where it says that uh, we had cotton futures being traded in Bombay in India by around 1875. So back then also we had derivative trading in terms of cotton futures, or you can say the commodity derivatives being traded in India. And obviously, like I said earlier, that commodity derivatives are more popular in India, so this expanded to various other agricultural products being traded on derivative markets through future contracts. So be it be edible oil seeds or raw jute goods, bullion, various other things started. Then again, just a little more background of where is it all coming from. So a lot of a lot of assets, underlying assets were traded through derivative contracts in unorganized markets as early as 1900 in Mumbai. So the concept behind unorganized, I'm gonna make clear in the upcoming slides, right? So we have the SCRA. Now, SCRA had banned all kinds of options in 56, and then they removed it somewhere around the ban they had removed somewhere around 95, and then we had currency options coming in, and then somewhere in 1999 we had SCRA making amends in their act and calling derivatives also legal and valid securities. You understand these kind of things are important. For example, if you see uh, today's environment, you would see that uh, there is a lot of hype about cryptocurrency, but still a lot of acts of particular nations are not giving them legal recognition, and unless and until that does not happen, you would not find a lot of liquidity, a lot of movement in that in those kinds of particular assets or stocks or the underlying securities. So this step was very important when SCRA gave legal status to derivative securities in 99. And since then we have a lot of other options that are permitted through RBI. We have swaps, we have various other derivative products in India. Also, at this point, I'd like to tell you that in comparison to other developed nations, India's derivative market is not as established. And I think I have said this point many times in class also, that our equity markets are well established, but when you talk about our derivatives market, not as well established as the international markets out there. But if you just have a look at the next slide that I have for you, so it gives us the present scenario of what is happening in the derivative world. So the first point that I have here is that says that NSE has become the world's largest exchange by trading volumes, outpacing US based Chicago Mercantile Exchange CME Group, the world's largest derivative marketplace. So now this feat of topping the volume league table by NSE is definitely noteworthy, especially given the hostility derivatives tradings has faced in India in recent years. However, if you look at the other points that I have mentioned here, we will try to see and evaluate if in real sense are we going up, is our derivative market growing by size. So if you see at this point, it says that in value terms, NSE is still far behind the CME and the Intercontinental Exchange. So in 2019, we have been able to get about 6 billion contracts traded volume, which is up by about 58%, which is obviously a great thing. But that is in terms of trading volumes, not value terms, right? And NSE's total revenues, if you have a look at, they were around 123 million in the quarter ended September 19. Revenues of CME, IC, just have a look at them. They are in billions, $1.3 billion, $1.7 billion, almost 10 times higher, right? Uh, we definitely have a lot of participants uh, on our NSE derivative platform. So we would have FPIs, which are your foreign portfolio investors. We have your uh, domestic institutional investors like your mutual funds, insurance companies. We have various other wealthy investors, proprietary traders. But however, these are the revenue figures. If you look at uh, this point here, we're talking about the average size of contracts that are traded. So about 70% of NSE's total volumes come from equity index options, right? So a lot of participants that I just mentioned about, the FPIs, the domestic institutional investors, and other people, they are more inclined towards equity index options, and we do not have as we call them, the complex derivatives. We don't have exotic options and the synthetic futures and options and the basically complex derivative types. So major proportion is towards the equity index options, which are far most the simplest, I would say. Um, and then it's giving us the average size also. For NSE, we have the size of the ticket size, you could say here, is about $9,500. In contrast, just have a look at the CME's figure. Then there's this term open interest. What is open interest? First, I need to tell you that, and then I'll explain to you this point. Open interest basically states the number of contracts which are still due in the market, and they are yet to be settled. If you would be looking at a lot of business reporting news channels, especially CNBC, probably on the bottom bar on their display screen, you would always see this term open interest. So, what is this open interest? It's telling you how many contracts are due or open in the market. And when I say contracts, I mean contracts, I don't mean parties. Because, see, two parties would be there in one future contract. So, when we are counting open interest, we would count the number of contracts. So, that ways. And obviously, the higher the number of open position, it gives you a good encouraging sign of the market. It tells you that there is probably higher commitment by the participants. So the number of open position also determines the bullishness and the bearishness that is there. And when you look at this point that I mentioned here, open interest in equity index options stood at about 3.47 million contracts in December for CME, and for NESC we have about 0.1 0.1 time its average daily volume. In NSE's case, open interest in equity index option segment was merely zero point 0.1 its average daily volume. Moving on to use of derivatives. So before I give you a description on this visual graph here, I want to just emphasize a bit on the need for derivatives, and uh, not elaborating much, but quickly going through the points that why did we need derivatives in first place. So uh, if you go back to the post World War II era, what was happening? We were close to World War II, and somewhere there Bretton Woods came in, and the Bretton Woods system of internationally fixed exchange rates came in, and all the countries' economies started operating under it. But you would know that it was short-lived, and somewhere in 1970s, we had the depression. We had a lot of stress due to high unemployment rates, high inflation, all those things. So Bretton Woods was dismantled in 71. Bretton Woods dismantling meant that now the exchange rates would fluctuate. So that is one thing that happened around that era, that time period. And if you talk about India, what was happening meanwhile? We were opening up to other economies. We were getting, interactive in terms of globalization. So now we are opening up, and then we have various price fluctuations due to volatility that comes in because of the fluctuating exchange rates. what is it that we would want to safeguard ourselves from? We have new businesses and we have small businesses. What is it? What is the highest risk that somebody faces at this point of time? The risk that arises because of the uncertainty in the price movement, the price risk, the uncertainty arising from such scenario led us to go into derivatives. So what is derivative basically doing? It sort of provides us the security to manage the risk. And uh, I will just getting back to the visual here, the visual graphic here. I'll get into how you manage the risk. So that was the point where we entered. We entered the derivatives with the intent of safeguarding ourselves from the risk and from the price fluctuations and all those things. And obviously, even if you look at today's scenario, the businesses around the world grapple with you know complex and volatile environments. So their derivatives play a very important role in hedging our positions. So with that background, I want to tell you, and I think I've all obviously told you about the three categories of investors that we have in the markets: the hedgers, the speculators, and the arbitrageurs. So with that intent, hedgers came in the market. Who are the hedgers? People who want to hedge their risk by taking certain positions in the derivative market. So to give you a very simple example, let's say that there are two parties. One is the buyer side, the other is the seller side. So from the buyer's point of view, whosoever has to buy any asset, any security, what is the main intent or the aim? To buy at the minimum price. And from a seller's point of view, the aim is always to sell at the highest possible price. So what are the price risks associated with both these parties? If we talk about the buyer side, the price risk is that the prices will go up. And from a seller's point of view, the price risk is that the prices will go down. So this is a very basic, simple kind of example to tell you that what is exactly price risk. If we talk in terms of long position, short position, I'll just explain you first of all what is long position, what is short position, and then come to this point. So first, for your reference, what is long position? Long position means that investor has bought and owns those particular shares or those stocks. So already has those things. All right. In terms of short position, it's vice versa. In terms of short position, you first sell. Okay. So if you are in long position, first you will buy and then sell to close your existing position. And in case you are in short position, first you will sell and then you will buy to cover that existing position. So if you look at now, having explained long and short position, if you look at it from that point of view, long and short position. So investors who have long position in asset, that means they have already got the asset. Now they want to sell to close their existing position. And if they want to sell, the aim would be to sell at the highest possible price. So the price risk that they face would be that the prices will go down. If you take example of somebody who's in short position, an investor who's in short position, this guy has already sold the asset and now he will buy to to cover his existing position. So if he's on the buying side, he would want to buy at the minimum price. The price risk that this guy faces is that the price of the asset might go up. The person in short position faces the price risk that the asset prices might go up. So in such scenarios, they would want to fixate their prices. They don't want to, uh, uh, you know, be dealing in these volatile kind of environments. They would want to hedge their position. They would want to secure themselves from price risk, basically immune themselves from price risk. So they would enter into derivatives. And such investors are called the hedgers. Hedgers, people who are entering in the market into the investment scenario or the future market to avoid risk, to basically protect themselves against the price changes. If you talk about speculators, now these guys have no price risk as such. They are not having the securities, they're not in long position, short position, anything like that. What are they there for? They just want to, assume the risk for hedgers. And while they accept the risk in the future markets, they try to make profits from price changes, because they have this sense of assessment of the future price movements, and they want to make profit out of it. So they are not there to hedge their price risk, but they are just there to make profits out of the price movements that might happen in the market. How about the arbitragers? Arbitragers are the people, the investors who generally like to exploit the possibilities that are there because of the discrepancies in the pricing. So, any moment that they feel that there's a discrepancy in the pricing, the cash pricing, and the pricing in the market of a particular asset, they would enter the market to lock in their profit, and it is them who rather bring the equilibrium in the market. Coming to type of derivatives, there are majorly four types: futures, forwards, swaps, and options. For your syllabus purpose, we'll be covering future, forward, and options, not swaps. However, in very briefly, I could tell you what are swaps. So, moving on. First of all, if you think from hedger's point of view, because that is the uh, truest truest sense, that why would somebody enter into derivatives market? To hedge their price risk. So what are futures and forwards? These are basically agreements between two parties where they set a contract to buy or sell a specified asset at a predetermined price on a specified future date. And why are they doing all of this? To uh, hedge their price risk. For example, like I have already told you in the previous slide, but just to reiterate, uh, let's say that I have a farmer who is sure that their farm would produce about you know 1,000 kgs of potato, and that would happen 3 months from today. And the farmer wants to be sure that he is able to sell that quantity of 1,000 kgs of potato at a good selling price. He does not want to face the risk that after 3 months today, after 3 months from today, the price of potatoes fall down. So it's better for him if he gets into an agreement with one of the buyers, and they specify that at what rate he is going to sell the potatoes 3 months from today. When this kind of agreement happens in a private space, when there is no organization in between, no regulator in between, no standardization is there, a very customized sort of agreement happening between two parties, a private bilateral agreement, it's called a forward contract. And because it's not standardized, it's not on the exchange, there is no institution in between, it is also called over the counter. It's being traded over the counter, or as we say, OTC. And again, futures, very similar. There's an agreement between the parties to buy or sell the commodity at a predetermined price on a specific date. But all of this is happening with a regulator in between. It's a standardized sort of agreement. It's happening on an exchange. So this is more formal in that sense, and thus it's called a futures derivative contract. If you talk about options, what are options? Option gives you the right. For example, just to get back to going back to the forward and future that I just explained. Now, in both the contracts, be it be forward, be it be future, there are two parties entering the contract, and ideally both of them should uh, abide by their contract side. They should fulfill their uh, whatever they said in the agreement. They should fulfill their saying, whatever there was. So they both have to oblige by the agreement in forwards and futures. But what happens in options? In option, you get the option. You have the right. If you wish to, you can exercise the right. And you can do your part of the duty. You can do your part of the agreement. And if you don't wish to, then there is no obligation on you to definitely do it. So obviously I will explain more on options in the upcoming slides, but just to give you a brief idea, what we are saying is that options gives the option holder. There are two parties here. Under options, there always be two parties, option holder and option writer. Option holder has the right, whereas option writer has the obligation. So somebody who has the right, if they wish to, if it suits their whims and fancies, they can uh, do their part of agreement, and if they feel that doing their part of agreement would rather lead to some sort of loss, then they're free to go. So that's options. Coming to swaps, swap is a derivative contract where the buyer and seller would settle the cash flows on a predetermined dates. Now there are mainly two types of swaps that happen. So one is on the interest rates, the other is on the currency. And since it's not part of your syllabus, let's move ahead. Coming to futures contract. Now, like I've already told you, it's a bilateral contract in which two parties agree to buy or sell an underlying at a predetermined price at a specified date in the future. Futures are traded on organized markets or exchanges, so they are standardized contracts. Here you see a clearinghouse in between the buyer and the seller. The buyer will operate through his or her broker, the seller will operate through his or her broker, and in between is a clearinghouse, making sure that both parties abide by their side of agreement and there is no counterparty risk that the other party defaults. So, to get away with that risk, there is a clearinghouse in between. And since these are traded on the exchange, they are standardized, so these cannot be custom made. All right. And how does the clearinghouse ensure that neither party defaults? First thing first, they take initial margin. Whenever a buyer or a seller is entering into a futures contract, they have to set in an initial margin with the clearinghouse. And then when you're entering into a contract, the movements happen mark to market. The balances are settled M to M. They are settled every day. So every day there will be a profit in somebody's account, either buyer's account or seller's account. Every day there will be a P&L thing happening because of M to M. So the clearing house in between is ensuring all this process goes smoothly. The agreement is same, that they're buying or selling something at a specific price at a specific date in future. And the only difference between a futures contract and a forward is that futures contract is more standardized and it is traded on exchanges. There's a clearinghouse in between, there's a margin requirement, and the settlement happens M to M. If you look at the forward contract here, again, the first point is just the same, so not repeating it. You could obviously read it from the slide. And what do we call the forward contracts? We call them over-the-counter contracts. You see here, between buyer and seller, first of all, there are no brokers, and then there's no clearinghouse. So obviously, a very high counterparty credit risk. The parties can default on each other, right? And because there is no margin requirement, no margin call, you cannot be assured of your assured of other party performing their side of uh, action on the agreement. To bring it all to summarize, this is a tabular representation for futures and forwards. Quick look, futures are traded on organized markets, forwards are traded over the counter. In futures, obviously, because it's on the markets, because it's on the exchange, because they are standardized, there would be high liquidity and positions can be easily liquidated at any time. Vis-a-vis, you look at forwards, there won't be any liquidity, right? Futures are highly standardized, forwards are customizable. It's up to you. You can make it up to any maturity, any quantity, any underlying. Very peculiar point about futures is that when you trade in derivatives market, you trade in lots. So the lots are specified already. You cannot change them. You cannot say, no, I don't want shares for these many shares. The lots are already prescribed. So in that sense, they are saying that it's standardized, whereas a forward is not standardized, it is customizable. Then obviously in futures, like I earlier said, there are margin calls that happen. P&L is accumulated day after day. In forwards, settlement happens at the expiry date, at the maturity of the trade. So it does not have M2M settlements. In futures, you would not have any counterparty credit risk, except bankruptcy of the exchange, highly unlikely. And in forwards, you would have counterparty credit risk. Before we move on to next slide, I don't want you to feel restricted by thinking that I've just given you an example of hedging for the sake of price risk in commodities. Let me give you an example of contract where the underlying could be a financial asset such as currency. So say that there's a company from US and they're going to receive payment in euros in 3 months time. Obviously the company would be worried that the euro will depreciate, and they can, for that matter, they can enter into a forward contract to hedge the risk. So basically what are they fearing? They're fearing that they will receive less dollars when they go out to exchange the euro in the market. So what they can do is that by using a forward contract, the company can sell the euro right away at a predetermined rate and avoid the risk of receiving less dollars. So that could be one example. Again, very hypothetical sort of example for where the underlying asset is currency. Moving on. Now we have the key specifications of derivatives. So, like I've already told you, when we're talking about forwards and futures, we saw that futures are exchange traded derivatives, whereas forwards are over the counter derivatives. So, what are we saying? That over the counter derivatives such as forwards and swaps are bilaterally negotiated, and the terms are flexible or customizable, and these contracts have substantial credit risk. Now when they're saying credit risk, this is the risk that the counterparty that owes money defaults on the payment. And in respect to OTCs, in India, OTCs are generally prohibited with some exceptions. I think those that are specifically allowed by RBI, RBI can have over the counter contracts. Right. Now, moving on. What are we saying? We are saying that uh, standardized contracts, such as futures contracts, uh, they are standardized. They specify the underlying asset. to be delivered, the size of the contract, logistics, everything, and they trade on organized exchanges, right? So when they're trading on organized exchanges, what they're doing is that they are eliminating this credit risk first thing. And how are they eliminating the credit risk? By having both the buyers and sellers uh, agreeing to deposit margin money with the exchange, right? Moving onwards, what are we saying? We are saying that in case of futures, there's a clearing house, there are margin requirements in daily marking to market, which is daily M2M, which substantially reduces the credit risk in comparison to the over the counter contract. So just like I said, that if you have an exchange reduces the uh, credit risk or the counterparty default by ensuring, first of all, both the parties pay a margin money, and then the settlements happen daily. The settlements are marked to market daily. So they happen until the day of the contract. So all of this ensures that the credit risk is eliminated, right? Then they're saying that there are five clearing corporations operational in India. You would know again what is the uh, objective of the clearing corporation. They are guaranteeing that the default risk does not happen. That's what they are doing in there. All right. Then we are coming about talking about contract specifications. Now, one specification, especially in case of exchange traded contract, is the lot size. Your lot size? Lot size is the quantity of underlying asset that has to be delivered under one contract. And the lot size could be different for different derivative securities. For example, equity derivative on stock A might have 300 shares as lot size, whereas equity derivative on probably stock B could have 100 shares as lot size. So you have to remember that this lot size would vary, and this is the quantity that has to be delivered under one contract. So that's one thing. Next thing that we have is that in India we have three future contracts available. Contract corresponding to their expiry date at any point of time, near month, next month, and par month. So what are we saying is, before I explain you this point, just have a look at this point where it says that each contract expires on last Thursday of the respective month. So this is the rule, that each contract would have to expire on the last Thursday of the respective month. Then what happens is that uh, on Friday, every month on Friday following this last Thursday, new contract comes into picture, comes into cycle. All right. So new contract having a 3 month expiry is introduced for trading on both NSE and BSE. So here when you see near month, next month, and far month, this is saying that the maximum trading cycle for any derivative contract on NSE or BSE is 3 months, and those 3 months are near month, next month, and far month. To explain you what are these, so for example, I enter into a derivative contract or any future contract for that matter on 10th September 2019. So the near month or one would be the that which expires in September itself. Next month one would expire in October. Far month would expire in November. That is what it means, and this I've already explained. Price on future contract is discovered on the basis of demand and supply coming from buyers and sellers of such contract. You would already know that the dynamics of demand and supply work. Here, initial margin. So I've already told you for a futures kind of uh, contract, where it is exchange traded and it is standardized. Both buyer and seller have to deposit initial margin with the clearing house, and this is to ensure that uh, the either party does not default. So initial margin has to be paid, has to be parked in the margin account by both buyer and seller at the time of getting into any futures account. Initial margin varies daily as it depends on futures price volatility. And what is initial margin? Percentage of future price into lot size. Always remember, one contract is made of, under one contract you would have a particular lot size, right? I'll just come to this table also to explain what is initial and maintenance margin, but let me just go with these lines first. What are we saying about maintenance margin? Maintenance margin, sum which must be maintained in by both buyers and by both buyer and seller in their margin account once the trade has started. Why do we need to maintain certain margin? Because I told you that when it is an exchange traded contract, it is settled marked to market. It is settled on a daily basis and it is cash settled generally. So we are not playing with the actual notional value of the whole sum. Rather, people play with the margin amounts. So margin amount has to be deposited. Maintenance margin also has to be deposited and has to be kept at the level. And as the contract starts, the margin amount would increase or decrease depending upon value of stock, but balance should not fall below maintenance margin. Okay. Now here, whenever the balance in the account falls below the maintenance margin, you get a margin call. And when you get a margin call at that time, you have to deposit the amount which moves of the margin amount to the initial margin. Now at this point you could say that we were falling below on maintenance margin. Then how come you're saying that we have to bring back the balance amount to the initial margin? That is the rule. If you get a margin call, meaning your balance is falling short on the maintenance margin, you will have to bring it up to the level of initial margin. Let's come to this table. What am I trying to tell you through this table is that let's say, for example, on 10th September 2019, somebody buys, an individual buys a 1 month future contract on stock A, and the stock price of stock A on that particular date was 2500 rupees. The contract size was 200 shares. So this is the lot size, contract size slash lot size. The total value would be 2500 into 200, which is 5 lakh rupees. Now please, when I said I just use the term notional value of the contract, the total value of the contract. Nobody is asking you to deposit this sum. We are not playing with this big sum. We are only gonna play with the margins, which are just percentages of this total value. All right. So let's say the broker charges initial margin of 15%. So 15% of 5 lakh rupees would be 75,000. And obviously, the amount of initial margin is based upon volatility in the price of the stock. Higher the volatility, it will lead to higher initial margin on futures contract. And as far as your maintenance margin is concerned, let's say that the broker charges 7.5%. Generally, brokers charge less maintenance margin as compared to initial. That is the rule. Initial margin is more, maintenance margin is less. So let's say that the maintenance margin charged by the broker is 7.5%. That means that the buyer of the stock has to maintain at least 37,500 rupees as his margin at any point of time in the account, the maintenance margin. And if the balance falls short of 37,500, He'll get a margin call and he will have to bring back, add more money, bring more money to bring it to the level of 75,000, to the level of initial margin, right? Let's have a look at next slide. What are we saying? We are just reiterating the points here. We are saying that gains and losses are settled on each trading day. This exercise is called mark to market settlement, right? So when the value of the contract is marked to its current market value, it's called mark to market. Daily settlement happens. The exchange, with the help of brokers and clearinghouse, would collect this mark to market margin from the loss bearing party and transfer it to the gain making party, gain eligible or recipient party. So if I am making a gain, where am I gonna get that gain from? From the counterparty, from the other party. The clearinghouse would settle that for me. Okay, so if you don't maintain the amount equivalent to the maintenance margin, then you're bound to get margin call. I've already told you about this. Let me just get back to this table here. Now let's say that I bought same everything remains same on 10 September, 1 month future contract on stock A, stock price was 2500. Let's say on just the next day, 11 September, the future prices closes to 2530 rupees. Okay, so the investor would have made a gain of 30 into 200, which is 6000 rupees. So the gain would be credited in the account and debited from the account of the seller. That's what we are saying here. That the exchange, with help of brokers and clearinghouse, would collect mark to market or margin from loss bearing party and credit it to the gain recipient party, right? And from next day onwards, from that means 12 here we had 10 September, we took hypothetically we assume that on 11 September the share price rising to 2530. From 12th September onwards, the stock price would be uh, considered as 2530, and that's where we'll start from the next day. So these are daily mark to market settlements. All right. Then what are we saying here? We are saying that from October 2019, all stocks in the derivative segments will be physically settled at end of the expiry unless squared off or rolled over, as market regulator aims to curb speculation and volatility. So what they're saying is that if before expiry you don't square off your position or settle your position or basically exit your position, then you would not go in for cash settlement. Then you will have to take physical delivery or maybe give physical delivery of the underlying stock in the contract. So that's a new thing that has come up, and that is to curb speculation and volatility. Because otherwise, if you see, everybody is playing on the margins only. The total value of the contract could be much higher, but margins are just a minimum portion, and playing on margins, people are able to make a lot of profits, a lot of money, which is purely speculation. So therefore this announcement by the market regulator to curb speculation and volatility. Now, basis this, you could say, how do you settle your contracts or how do you exit your contracts? It's very simple, but still, how do you exit? You obviously can exit from your future contracts before expiry. Either you sell the contract or you take a opposite position in new contract. which has the same expiry and contract price. So that is offsetting. This is offsetting. If you take an equal opposite position, then you have squared off your position, or as we say, you have exited your position. So that is very much possible. I've given you an example here. Let's say investor holds a long position in a 3 months future contract, and after 2 months he can either sell his contract to another buyer, or what can he do? He can take a short position because he was in a long position. So the opposite would be a short position in a 1 month future contract because 2 months have already passed. So you can take a short position in a 1 month future contract. Profits and losses would be credited to and debited from your margin account after the adjustment of margins. So that is how you can settle your future position before expiry of the contract. Now we move on to valuation of futures contract. This is a valuation model for futures contract, and this is more of theoretical in nature. The model cost of carry model is followed to take out the value of the future contract or the price of the future contract, because in reality the actual price of future contract is determined through the forces of demand and supply in futures market. But however, when we talk about cost of carry model, here the theoretically the price of futures contract is sum of the prevailing spot price and the cost of carry. So that is what is there in the cost of carry model. If you see, cost of carry is just a jargon that is used in futures. It is basically the risk free interest rate that could be earned by investing your money in a safe investment such as government bond. So it represents the cost of carrying or holding an investment. The formula under cost of carry model, the formula is to price the futures based on cost of carry or risk free investment opportunity. So the expected return is on how you expect future contract itself to perform across your holding period. That is what is the essence of cost of carry. Sum of where the future contract is sum of prevailing spot price and cost of carry. And when we take out such values theoretically through this model, we get some mispricings. And mispricings in the theoretical value would obviously unearth arbitrage opportunities, and such mispricings can be used effectively to earn risk free profits. Now, looking at just the notations which will be used, which are used for cost of carry model, S naught is your spot price today. So the price today is S naught. Then we have F naught. F naught is what we are trying to calculate, futures or forward price. T is the time until delivery date, and R is obviously the risk free interest rate for maturity T. So cost of carry, risk free interest rate. Now let's look at three situations that could be there under valuation of futures contract. Coming to situation 1. Situation 1 is when the underlying asset provides no income or dividend. So it's the formula is very simple. The price is merely the future value of the spot price of the asset. Here F naught is the future value or the future price. S naught is your spot price, the price today. E is your log value or the exponential value. R is the risk free rate. T is your time to maturity. Let's have a look at the example. It says IBM is selling for 68 per share. It's selling for 68 per share. That means that's the stock price today. Spot. The spot price S naught is 68. Zero coupon interest rate is 4.5%. That means the risk free rate is 4.5%. What is the likely price of 6 months future contract? The time given to us is 6 months. Spot price 68 into E raised to the power R. R was 4.5%. You know, we don't directly write percentage, we convert it to decimal points. 4.5 converted to decimal 0.045 into T. T is 6 months future contracts. So to adjust it for 6 months, 6 by 12, which comes to 0.50. And you get the future price, at least the theoretical fair price of your future contract, right? Let's move on to your next situation, when the underlying asset provides income or dividend. So when there is a component of dividend, there's a little tweak in the formula. What is the tweak? The only thing that is different is that we have deducted the dividend payment or the income from the spot price. You look at the formula that we had. F naught is equal to S naught E raised to the power RT. The moment we have some dividends, we've deducted them from the spot price. And why are we doing that? We are doing that because if the dividend is paid by the company, if a company is already paying me certain dividend, then the amount that I require to invest in that company would be lower. So that's why this dividend portion or the income portion is subtracted from the spot price. Logic is simple, that if dividend is paid by the company, then the amount required for investment would be lower. The price is merely the future value of the spot price of asset less dividends paid. And always remember that here the dividends, when we subtract the dividends, we have to take the present value of dividends. Let's have a look at the question, very similar to the previous one. Spot price 68 per share, risk free rate 4.5%. The stock pays $0.75 in dividends in 3 and 6 months. What do we have to do? First we take out the present value of these dividends and then subtract that from the spot price. What is the likely price of the 6-month future contract? This is how you calculate the theoretical value of a future contract when the underlying asset provides income or dividend. S naught minus the present value of dividends. This is E RT. Where is this 1.47 coming from? This is how we calculated the present value of the dividends. 0.75 received in 3 months and 6 months. So 0.75 by ERT plus 0.75 by ERT. R remains the same, the risk free, which is 4.5. In both the cases, T changes 3 months and 6 months, so 0.25 and 0.50. You come to your present value of dividends, you subtract it from your spot, and you get your theoretical fair price of the future contract. So that's situation 2. Let's come to situation 3. Situation 3 is when dividend expected is expressed in percentage terms. We just modified again the formula a bit. When the underlying asset provides income yield or dividend yield. Here we had absolute numbers in terms of the income or the dividends that we were receiving. Here we would have the percentages. So very small little change what we are doing is we have this thing called Q, the known continuous compounded yield, right? It is the expected rate of dividend or dividend yield. So what do we do is that here the adjustment is made with the rate, the risk-free rate, the adjustment of dividends. You remember we were subtracting dividends. In the previous case, we subtracted the dividend from spot price when dividends were given to us in absolute terms. When they are given to us in percentage terms, we subtract it from the risk free rate. That is the only difference. F naught is equal to S naught E R minus Q into T. Right? So, question here, example, stock index is selling for $500 spot price. Zero coupon interest rate is 4.5%, the risk free rate is 4.5. Index is known to produce a continuously compounded dividend yield of 2%. That's your dividend yield, 2%. What is the likely price of the 6-month futures contract? F naught is equal to S naught E raised to the power R minus Q into T. We are given almost all the values and we substitute them in the formula and we get the theoretical fair price under situation 3 as well, right? So just to sum up the situation 2 and situation 3, if expected dividend is expressed in terms of money, we deduct it from spot price. Whereas if it's a specific dividend yield, then adjustment is made in the rate of return, risk-free rate of return. That is your valuation. Now, also remember whenever you take out, be it be whichever situation, whenever you're taking out your theoretical future price, you need to multiply it with the lot size or the contract size uh, to get the value of the full futures contract. And in terms of future contract price and actual price that is prevailing in the market, if there is difference between the two, you can easily find out that if the particular security is underpriced or overpriced. So if the theoretical price is higher than its actual market price, then obviously the future contract is underpriced and you should buy it. And if theoretical price is lower than the actual price, then such future contract is overpriced and you should sell such future contract. So it does help a bit with the investment decisions out there.